All right, welcome. Today, we're going to cut through all that crypto hype and get right down to the real numbers. In this explainer, we're going to build a really simple mathematical blueprint so you can evaluate projects with clarity, not just a gut feeling.
Have you ever heard this? Or, maybe even thought it yourself? Well, I'm telling you, this one thought is probably the single biggest and most common mistake a beginner can make in the crypto space.
And that's exactly why we're here. This explainer is basically the antidote to that mistake. We're going to completely ignore the noise, and instead, we'll focus on just 4 crucial numbers that give you the real picture, moving way beyond just the sticker price of a single token.
These are the 4 things we're going to talk about: market cap, supply, fully diluted value, and, of course, liquidity. By the end of this, you'll know exactly what they are and why they matter way more than just the price tag.
Okay, so here's the absolute key takeaway right up front. Price is just the cost of one unit. Value, on the other hand, well, that needs context. A token that costs 1 cent is not automatically cheaper than a $100 one, and we're about to see exactly why that is.
All right, let's start building this out. We're going to kick things off with the most important concept for fixing that price-based thinking: market capitalization.
So what is market cap? It's actually super simple. You just take the price of one token and you multiply it by how many of those tokens are actually out there, circulating in the market. This is your starting point. It's how you compare projects apples to apples and understand the true size of a project.
Okay, now check this out. This is where it gets really interesting. So you look at token A, 1 cent. It looks like an absolute bargain, right? And then you see token B at $100 and think, whoa, expensive. But look closer. Their market caps, they're exactly the same. This is the aha moment. It means in terms of their total value, they are the same size. That 1 cent token is not cheaper at all.
So here's a really powerful mental tool you can use. Next time you hear someone screaming that a token can easily 10x, pause for a second. Don't think about the price. Just ask yourself this one question: what would its market cap be? If the answer is some ridiculously huge number, you're probably looking at marketing, not math.
All right, next up we have FDV. That stands for fully diluted value. Think of it as market cap's cousin. But instead of using the circulating supply, the coins out today, we use the total supply. That's every single token that will ever exist for that project, giving us a peek into a potential future valuation.
And this is the key question that FDV helps you answer. If you spot a project and think, wow, the market cap is pretty low, this looks good, but then you see the FDV is absolutely enormous, well, that should set off some alarm bells. It means there's a huge supply of tokens just waiting to hit the market, which could create a lot of selling pressure later on.
Okay, let's keep moving. So, beyond just figuring out the value, there are some hidden risks you have to be aware of, and you find them by looking at supply, and a metric that's often ignored: liquidity.
And the difference between these two is absolutely critical. Circulating supply is what's out there right now, what you can trade today. Total supply is everything that could be out there eventually. When you see a huge gap between these two numbers, it means you need to do a little homework on when and how new tokens are going to be released.
Yeah, this visual here really drives the point home. You see that little slice? That's what everyone is buying and selling today. But that massive remaining piece, that's all potential selling pressure down the road. It doesn't mean it's a bad project, not at all. But it means you've got to investigate their token release schedule.
Okay, our last concept is liquidity. And honestly, this might be the most overlooked metric of them all, but it answers a super simple, absolutely vital question. If you decide to sell, can you actually get out of your position without the price tanking on you? I absolutely love this analogy. It just makes the concept click instantly. Low liquidity is like a shallow kiddie pool. Even a small person jumping in creates a huge splash, right? That's what happens with prices. A small buy or sell order can send the price flying up or crashing down.
And the real-world consequence of this is just massive. In that shallow pool, one person deciding to sell can crash the price, and suddenly you're trapped. You can't get out of the price you thought you could. But in a deep pool, high liquidity, big orders get absorbed easily, and the price charts you're looking at are way more reliable.
Okay, I know that was a lot to take in, but the good news is we can boil all of this down into a super simple, actionable checklist you can literally run through in 30 seconds. Here it is, your 4-step mental checklist. 1. Check the market cap to get the true size. 2. Compare circulating versus total supply to look for future dilution. 3. Glance at the FDV for that future context. And 4. Get a feel for the liquidity to see if you can even trade it properly. That's it. This simple process will help you dodge a huge percentage of the most common beginner mistakes.
And of course, just the standard but very important reminder, this is all for educational purposes. It is absolutely not financial advice. Digital assets are risky, so please always do your own research. So I'll just leave you with this one final question to think about. The next time you're looking at a project, ask yourself, are you just looking at the marketing hype, or are you taking 30 seconds to look at the math that tells the real story? Thanks for tuning in.